Most beginners in 26 will make one silent investing mistake, and they won't even realize it for years. They'll chase trends, pick random stocks, switch strategies every few months, and quietly lose time, the most valuable asset in investing. But there's a simpler way, a way many long-term investors use to build real wealth without daily stress. Index funds. Today, I'll explain what index funds are, why they work, and which types beginners should focus on in 2026. Stay with me until the end, because choosing the wrong structure can quietly cost you thousands over time. First, what is an index fund? An index fund is an investment that tracks a group of companies instead of trying to beat the market. Instead of picking one stock, you buy a piece of hundreds, sometimes thousands. For example, when you invest in a fund that tracks the S&P 500, you're investing in 500 of the largest companies in the United States in one move. No guessing, no stock picking, just broad ownership. And ownership is how wealth is built. Now, here's why beginners prefer index funds. They are diversified. If one company performs poorly, it doesn't destroy your entire portfolio. They are low cost. Most index funds charge very small management fees, which means more of your money stays invested. They require no daily management. You don't need to monitor the market every hour. You invest consistently and allow time to do the heavy lifting. So what types of index funds should beginners consider in 2026? Not specific tickers, not hype funds, but structured categories. Because smart investing starts with structure, not excitement. First category, total market index funds. These track the entire stock market. Large companies, mid-sized companies, small companies. You're essentially investing in the whole economy. For beginners who want simplicity and broad exposure, this is often a strong foundation. Second category, S&P 500 index funds. These focus on the largest U.S. companies. Historically stable, widely used, simple to understand. Many long-term investors build their core portfolio around this type. Third category, international index funds. These provide exposure outside the United States, Europe, Asia, emerging markets. This adds global diversification, because the world economy is bigger than one country. Fourth category, bond index funds. These are generally more stable, lower growth potential, lower volatility. Some investors use them to balance risk, especially as their portfolio grows over time. Now, here's something most beginners misunderstand. The best index fund isn't the one with the highest return last year. It's the one with low fees, long-term consistency, and alignment with your risk tolerance. Chasing performance often leads to emotional decisions. Structure builds wealth. Let's talk mindset. Many beginners ask, which fund will make me rich the fastest? That's the wrong question. The better question is, which strategy can I stick with for 10 years? Because investing success is rarely about brilliance. It's about consistency, monthly contributions, reinvested dividends, patience during market downturns. That's where compounding quietly works in your favor. Index funds also reduce emotional pressure. No daily stock drama, no constant switching, no reacting to every headline. Just steady accumulation. And steady accumulation builds real assets. If you're starting in 2026, a simple beginner structure might look like this. Core holding, a total market or S&P 500 index fund. Optional addition, a smaller percentage in international exposure. Risk balance, a bond allocation if you prefer lower volatility. Simple, repeatable, scalable. Remember this. You don't need to outsmart the market. You need to outlast it. The goal isn't excitement. The goal is ownership. Because income pays bills, but ownership builds leverage, and leverage creates options. This video is for educational purposes only, and not financial advice. Always do your own research before making investment decisions. If this helped clarify index funds for you, subscribe for more structured insights on building long-term assets the smart way. And remember, you don't need complexity to start investing. You need clarity. I'll see you in the next one.